The door to Fed rate cuts may be open, but Jay Powell is still blocking the entrance. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu.
Our coverage of the Fed decision continues as we take you to the closing bell and beyond. A three-pronged Fed decision today by the FOMC to hold interest rate where they've been going back to late July, to continue quantitative tightening at the current pace, and to clarify that rate cuts will only come when the Fed is confident that inflation is nearing 2%. Now, Powell did offer a glimmer of hope, saying rates have likely peaked and can be dialed back, just not in March. Fed funds futures pricing, though, shows investors have high conviction for rate cuts in May, June, July, and at that September meeting. A big leg down on that two-year Treasury yield today, Scarlett, though a big portion of that move was less about the Fed and a little bit more about what's going on in the regional banking sector.
Absolutely. And if you take a look at KRE, the ETF that tracks regional banks, down as much as 5.6% after New York Community Bank reported a surprise loss. It announced a increase in provision for credit losses to $500 million. Analysts were looking for about a tenth of that.
Yeah.
So that raised a lot of eyebrows. Is this the regional banking crisis part two?
That's the big question. A lot of people saying this might just be specific to New York Community Bank Corp. I think a lot of investors, when you consider what KRE is doing, think otherwise.
Absolutely. And of course, Stryker, I just threw that in there because medical device makers are definitely in focus today after Stryker and Boston Scientific both reported results that topped estimates. And just another company to throw out there as well, Rockwell, the industrial tech company, falling the most since March 2020. Quarterly profits missed analyst estimates on lingering supply chain issues and still high inventories at customers.
Yeah, you combine the disappointing news out of the Fed and the disappointment out of earnings, and a big reason why you're seeing the S&P down 1.5% and the NASDAQ down 2%. But let's start off here with the big news of the day, then that is Fed Chair Jay Powell signaling he's in no rush to cut rates.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen. So I wouldn't call, when you ask me about in the near term, right. I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
Jay Powell there, Megan Swiber here, Director of U.S. Rate Strategy over at Bank of America. Look, this is now a big guessing game, not so much if the Fed is going to cut. And let's be clear, he kind of basically said the door is wide open to a rate cut at some point this year. When does that happen? Is it in April, or I'm sorry, in the May meeting, or do we have to wait all the way to December when the year is done and he says, see here, you got your rate cut?
Yeah, that's exactly the question everyone's asking, Romaine. And really the key buzzword here, we heard it from Powell multiple times. We saw them mention in the statement, is confidence. Is confidence that inflation is still on this path lower, that the disinflation that we're seeing from some components in the basket is still going to be at play here. The Fed is now thinking that March is going to be too soon for them to see that good evidence that inflation is showing good progress besides just the goods story that we're seeing, but also shifting to services. And it's buying them time. They want to maintain optionality. They want to see how this data is coming in.
It's buying them time, but how much time do they really have? I mean, you have a 10-year yield now firmly below 4%, excuse me. That 2-year yield down 9 or 10 basis points on the day. And that's been the trend for a while now. And at least based on the price action I'm seeing, and maybe you have a much clearer view than I would, but I assume that's a pretty large conviction here that rates are going to be lower at some point at the end of the year than where they are right now.
Yes, exactly. Yeah. And we see that certainly in the dot plot, and Powell is not dismissing that in any way. It's really just the timing. And the market has gotten very much so ahead of itself in terms of pricing where the Fed is going to end up by the end of the year. If you look, actually, I have a nice chart on this that I published, but you look at the difference between where the market had been pricing rates at the end of 2024 versus what the Fed has told us and guided us. We see a historically large wedge between those two things. So it was really Powell coming out and challenging, well, slow your horses here. We still haven't seen enough progress yet to go.
Absolutely. I think you said that so well. The fact that markets are getting ahead of themselves, and the Fed has made very clear that it needs to see more good data, not necessarily better data, just more good data overall. He says we're going to be reacting to the data. So by definition, that means the Fed is going to be behind the curve when investors are trying to get ahead of everything. Where does that leave investors in terms of how they position for when eventually they get the all clear from Jay Powell?
Yeah, great question, Scarlett. So what we're seeing in terms of how the rates market is responding to this already is investors are already out there extending duration, extending WAM, preparing for the Fed to be moving from hikes to cuts. A lot of that behavior has happened already. And really the market's already understood that, well, inflation's on its way down. Actually, if you look at the one-year inflation swap, there's a lot of confidence in just how quickly inflation's going to continue to cool down and come towards that Fed's target. So while Chair Powell's kind of walking some of this back, the market has a lot of conviction in this disinflation story. And so we've seen a lot of this behavior from investors, particularly in the rates market, happen already. Mm-hmm. We've seen a lot of investors move more overweight duration. We've seen some shifts in positioning. We've seen folks largely set up for a steepening of the yield curve, a very, very popular trade that we've seen in recent months. So a lot of this has happened already. And now it's just the fine tuning of this message. How much is the Fed going to cut? To what degree? And really the big question here is pace.
And what's interesting, too, I was just looking at Bloomberg headline across the wire. The Fed funds pricing continues to drop for that March meeting. Yeah. We were basically at a coin flip prior to the meeting. We're now down about 30% chance. But to her point, I think you look at the other meetings, and we're basically at about 100% probability, at least as what's being priced in for that May meeting through the September meeting.
Yeah, that's a really good point. Yeah. So what do you do between now and then when we actually do get that rate cut? You mentioned a steepening of the yield curve, how that's a popular trade increasingly. Is it an overcrowded trade right now?
It's a little tough to see. So one thing that we look at very specifically and what the market focuses a lot on are some of these momentum strategies. And we had seen CTAs in particular in a pretty meaningful way in that steepener position. But it's been a tough trade for the market. A lot of that has been the sensitivity of Powell pushing back on the cuts, some of the data that we've gotten, which has been really quite strong. So it's a hard trade to get right. And usually you don't see the curve really steepen out all that meaningfully until we see a rise in the unemployment rate. And this cycle may just look a lot different than prior Fed cutting cycles.
There's long-term investing in there, but there's a lot of tactical trades out there, particularly given all the volatility. Is that something that you and your team have your eye on?
Yes, indeed. Yeah. So, we continue to think that investors want to be trading the rates market tactically. Mm-hmm. You want to be taking advantage of points in time when rates are moving up towards that 425 or so level, buying at those levels. But if you're seeing rates drift closer to this 375 or so range, probably overdone. Because again, this cutting cycle could just look different. Yeah. The Fed may not necessarily be cutting all the way back down to 2% or the zero lower bound, as we've seen in prior cutting cycles. So we have to be cautious here. And the story is data dependence and that confidence on the inflation picture.
All right. Well, he did say the peak was in or likely in, which I think is about as definitive as you're ever going to get out of a Fed chair. Megan, great to have you here on set. Megan Swiber, Director of U.S. Rate Strategy over at Bank of America Securities, with about 2 minutes, I should say, until we get to those closing bells. Stocks right now in the U.S. hitting session lows. The NASDAQ 100 right now down almost 2% here on the day. The S&P down 1.5%. We're going to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenovic, matching in lovely blue. We welcome our audiences across all of our Bloomberg platforms, television, radio, originals, and YouTube. I send Scarlett a completely separate email. It's just like a joke I have with her.
I like to stand out with my outfit.
We're all wearing white today, Scarlett.
You stand out.
But look, we have to talk, of course, about the big news. The Fed meeting today, and really the market reaction to it, guys. We're looking at one of the bigger sell-offs that we've seen in the equity space, and of course, one of the bigger rallies that we've seen in the Treasury space in a while.
Yeah, right. That's certainly significant. We've seen that play off of it. Walter Todd, that we were just talking from Greenwood Capital, saying, I'm a little confused. I felt like the Fed was saying one thing in December and Jay Powell was saying one thing. And now it's like, March is completely off the table here, it feels like. So he felt like the mood was different. And then for equity investors, that meant, wait a minute, our expectations were too high, so we've got to pull back a little bit.
The message, though, is clear from Fed Chair Powell. He wants to see inflation come down. He wants it to be consistent. He doesn't want to get burned by 6 months of data. He wants to see more than 6 months of data, Scarlett. He doesn't, it's the concern, of course, is that the data that we've seen in recent months doesn't stick. And that's why he's telling people you have to be prepared for us to keep rates higher for longer.
Yeah, and for equity investors, the data coming out of companies like Alphabet, Microsoft was certainly nothing to celebrate, especially given how much those stocks had rallied after the last earnings report. Don't forget, Alphabet, Microsoft, big chunks of the S&P 500, the NASDAQ. We've got another 3 companies reporting tomorrow that can really set the tone for the rest of earnings season. season.
Yeah, this was such a weird confluence of events this week with all the big earnings, a big Fed meeting, and of course we still got more economic data, consequential economic data on Friday with that jobs report number. But you're seeing a lot of weakness right now in the markets here. They had kind of oscillated around earlier in the session, but after Jay Powell started speaking here, the direction really shifted to the downside. The Dow Jones Industrial Average lower by more than 300 points, or about 0.8%. The S&P is going to close out the day down about 1.6%, biggest one-day drop for the S&P going back to September 21st of last year, now camped out at that 48, 46 level. The NASDAQ Composite down more than 2%, its worst days since late October, and the Russell 2000, guys, down about 2.5%, Carol.
All right, folks, let's get to Qualcomm earnings just crossing, and let's get to the outlook because it's talking about second quarter revenue, the outlook here, 8.9 to 9.7 billion. Quite a range. The estimate out there on the street, 9.36 billion. First quarter adjusted revenue, 9.92 billion. Folks, that is a beat. The estimate on the street is 9.54 billion. So that initially, first quarter adjusted EPS, 275. Again, a big beat. The estimate on the street is $2.36 a share. And initially, Scarlett, we're seeing the stock up about 1.7% here.
Yeah, Qualcomm, of course, so critical in the smartphone market, and it's really kind of a barometer for demand for smartphones, which we know has slowed down, particularly in big markets like China for someone like Apple. So the fact that this revenue outlook is so broad leaves a lot of questions in my mind. It's going to really depend on how the company characterizes what it sees out there during the earnings call.
Cristiano Amon, in a press release, the president and CEO of Qualcomm, saying, looking ahead, we're building on the momentum with our leading Snapdragon platforms and tech differentiation and connectivity, computing, and on-device generative AI across handsets, automotive, PC, XR, and industrial Internet of Things, Romain.
Yeah, I mean, this is going to be the big story. I think everyone is really so focused right now on the health of the mobile market and obviously Qualcomm's space in it. And of course, we'll get a much better read on that when we get those Apple earnings in a couple days' time.
What's really interesting, too, is, we've got to keep an idea of whether or not, in terms of the PC side a little bit, like that is something we've been talking about a lot with the chips in general. But again, giving this revenue forecast for the current quarter in line with analyst estimates, recovering market, as they say, for smartphone chips. And you do wonder if there's an AI play here as well as they look at that part of the market as well.
Yeah, we talk again about handsets. It should be noted here that revenue from handsets for Qualcomm rose 16% in the fourth quarter, the fiscal fourth quarter, compared with a 27% drop in the previous 3 months. So there was a recovery, but the question is, how does that look going forward?
Yeah, exactly. All right, Qualcomm guys, we're going to keep a watch as we continue to go through the press release and comments, still up about 1.7% in the aftermarket. Let's get to some of the individual gainers, if I may, in this session. Paramount among them, a top gainer in the S&P 500 today. You know the story. We've been covering it at Bloomberg. Byron Allen, he's been making big plays, big bets in the media space, making a $14.3 billion bid to buy all of the outstanding shares of Paramount Global. It's about $28.58 a share. It's about a 50-cent premium for the voting stock. It involves voting and non-voting shares, I should point out, according to those in the know, including debt. It's a deal about $30 billion to Paramount, really an outperformer, up more than 6% in today's trade. Boeing also moving to the upside today. It did report revenue and free cash flow for the fourth quarter that beat analyst expectations. It's been on our radar amid all the worries over its 737 MAX lineup, if you will, and certainly the concerns there. Company, by the way, racing to complete a key engineering fix needed to certify the smallest version of its cash cow. Of course, again, we're talking about the 737 MAX jetliner, but nonetheless, investors giving some love to that one, up more than 5%. One more, ADP. We don't talk about it a lot. It does a lot of back office operations for companies, human resources, payroll, stuff like that. It was a top gainer in the NASDAQ 100. Earnings this morning, solid earnings beat and a positive revenue growth forecast. What it says to me is we are constantly watching these earnings reports, and it's really moving the names certainly at this time.
Well, quite a few notable decliners to get to. I do want to start with New York Community Bank Corp, plunging a record 46% at one point in the session before paring some of those losses, finishing down 37% on the day. This finishing falling the most since 1993. It did report a surprise loss tied to deteriorating credit quality, and it made a cut to its dividend. The company said it wants to build up loan loss reserves to be better in line with other banks of its size and get ahead of potential weakness in the office and multifamily property sectors. This is a big one. We got Frank Sorrentino on a little bit later from Connect One Bank. We're going to be talking to him all about it and what New York Community Bank Corp results mean across the sector. Also, got to talk about this tech companies reporting late yesterday and how they finished on the day. Let's take a look at Alphabet. ticker GOOGL. Shares finishing down 7.5%, biggest intraday drop in months. The company reported Google advertising revenue that was weaker than expected. And then AMD, another stock that reported yesterday, falling on the day today, finishing the day down by 2.5%. The chipmaker gave a revenue forecast that was weaker than expected, though analysts said that the guidance, even though it was particularly weak, they were encouraged by the ramp in its AI accelerators, Romain.
All right, let's take a look at what's going on in the Treasury market here, because it was a really wild day here. We started off the day with the Treasury market much more focused on that Treasury refunding announcement. Basically, the details here of the durations, the size of the durations that they plan to sell in the quarter here. And then, of course, you got that news out of New York Bancorp that you were just talking about. That also sent Treasuries much lower here on the day. And then we got that Fed meeting. The net effect of it all is we're down about 11 basis points on the 2 and the 10-year yield is down by about 10 basis points here on the day, but it was much more severe than that at one point. So what you're seeing is a little bit of a clawback of that, and it's kind of hard to even know whether these moves are actually because of the Fed, because of the regional banking issues, or because of the Treasury fund announcement. Maybe the answer is all of the above.
All of the above, probably. That brings to mind the next question, which is we have more data. We talked about how this is a monumental week with the FOMC, with big earnings. The jobs data comes up on Friday. Does that matter as much as we once thought it did, given what Jay Powell has told us?
I think it does. Yeah. I mean, I think there's going to be, after today's kind of soft report that we got today in the employment market, private payrolls at least, I think it does matter. If there's significant deterioration there, then that's kind of, bad news is good news. And I think if they show that there's significant hiring this month, because it is still January, then that's not so good news.
I'm confused, Tim, because Powell said that he was looking for good news. So is he looking for bad news, or is he looking for
No, he doesn't want the labor market to fall apart, right?
He
Didn't
doesn't,
he make that
but
very
if
clear?
the labor market does fall apart, then you can expect rate cuts sooner than later.
That's a market's interpretation.
Yeah.
Yeah, Powell wouldn't say that.
Yeah. Are you still confused, Romain?
Yeah.
Scarlett explained it.
I was born confused.
Okay. All right. Thanks, Scarlett.
I don't know. I feel like Jay Powell was really clear. Like he says, okay, we're at peak policy, guys. We're taking March off the table. Although he said May. Like I really feel like every meeting still is a live meeting, so we have to be smart about that. Mm-hmm. I just think he kind of laid it out, like that there's a lot of good momentum. Or Mike McKee trying to say, okay, if you're not going to call it a soft landing, do you call it a hard landing?
He dodged that one.
Right, he did. But he said, listen, there's a lot of good stuff out there, right? We're glad people are still working. Yes, it's softening in the labor market. We're going to watch that very closely. But I think this is the delicate part as you get to the end of a monetary policy.
Yeah, but they're very careful. He was very careful to not get too far ahead, right? We're not declaring victory. We have a ways to go. We're not saying mission accomplished on a soft landing, even though Janet Yellen, the Treasury Secretary, has said just that.
Yeah, well, she's not in the seat anymore, so it's easier. Listen, I think bottom line, data dependent.
She's still important, right?
Well, no, she's absolutely important, but she's,
she's the one selling all that debt that we can't afford. So,
I thought it was really interesting.
Give her a break.
Thought it was interesting in the simulcast. That's very fair, but it was just reminding that you can tell Jay Powell takes this very seriously, because when they were asking him, asking some of the guests about politics and so on and so forth, you can tell he takes the dual mandate really seriously. I think.
Yeah. His expression for some of the answers, he looked like he was pained to answer some of the questions.
Well, yeah. You feel like he's like, okay, I'm done.
If I had to stand in front of a bunch of journalists, I'd be pained too.
It's like quantify greater confidence.
Unfortunately, you have to do that all day, Romain.
All right, guys, that's a wrap. Our cross-platform on this Fed Wednesday. Radio, TV, YouTube, Bloomberg Originals. We're wrapping it up. A little bit of earnings as well, but we will see you again same time tomorrow.
And our coverage continues here on Bloomberg Television. Additional analysis into the big Fed decision today. And of course, a big read on where we go from here. Ken Shinoda, Seth Carpenter, Betsy Duke, John Taylor, just a few of the names we're going to talk to over the next hour. Stick with us. This is The Close on Bloomberg.
All right, let's give you a recap from those results out of Qualcomm right at the market close, giving a revenue forecast for this quarter that was pretty much in line with what Wall Street had anticipated. It's the second quarter revenue of $8.9 billion to $9.7 billion. Analysts on average were expecting $9.36 billion. Let's bring in now John Vinh. He is equity research analyst for KeyBank Capital Markets, and John has an overweight rating on Qualcomm. John, I want to talk about that forecast a little more. It's the fiscal second quarter forecast, so this current quarter. That range is about a gap of $800 million from the low end to the high end. What accounts for that? What does Qualcomm need to see, or how does it pin that down or narrow that down a bit?
Yeah, I think the range is maybe a little bit wider than what we normally would typically see out of Qualcomm. I think there's a couple factors that may potentially factor into that range. One is, there's a little bit of consternation in the supply chain about Apple demand. I think we've seen sell-through get a little bit weaker in the China market. We've seen it get a little bit weaker in the North American market. But we haven't seen major cuts out of the supply chain at Apple, more broadly speaking. Skyworks reported yesterday, and their results and guidance seems to imply that they haven't seen it. So I think there's a little bit of conservatism related to Apple. And then also on Android sell-through. We've seen more recently over the last several weeks that sell-through, particularly in the China market, has really started to soften. Mostly it's in the mid to low end segment, which doesn't really impact Qualcomm as much, but potentially management's taken a little bit more conservative view here by just widening the range a little bit.
So we're hearing from Apple suppliers like Qualcomm, like Skyworks, but tomorrow we're going to hear from Apple itself. Do you expect Apple will say anything that will give us more visibility into its suppliers, or is Apple going to be conservative as it usually is in giving an outlook?
Yeah, I would say that their commentary on the outlook is probably going to be conservative as they normally do. They obviously don't give you very explicit guidance like most other companies within the mobile supply chain do. But yeah, I would expect their commentary to be pretty consistent and vague as they have been in past quarters.
I am curious about the longer term story for this company. I mean, we already know based on, I think, some public comments by Apple, but certainly through our own reporting here at Bloomberg, that Apple is trying to sort of divorce itself and move on. Qualcomm has acknowledged that publicly. And I am curious about the pivot that they've been trying to make, the transition to sort of broaden out their consumer base, their customer base, I should say, and more importantly, just broaden out into different areas that provides a little bit more of a moat around them. How are they doing?
You're talking about Qualcomm or Apple?
Qualcomm.
Yeah, I think if you're Qualcomm, I think they're focused on kind of the next secular cycle, like a lot of companies in semis are, which is AI, right? I think their focus right now is embedding kind of generative AI capabilities in its Snapdragon processors. Snapdragon 8 Gen 3 has native AI capabilities that allow you to do inferencing on large language models. And I think that's going to be the next potential wave of growth. It's certainly early days. We certainly don't know what all the applications are, but in the near term, that's going to drive a nice uplift in ASPs for Qualcomm here.
I do want to just go back a little bit. We actually are getting another headline right now, John, on Qualcomm. This is coming out at the 10Q, basically addressing inventory levels and saying that they expect them to remain elevated in the, quote, near term. Wondering if you can comment on that. I don't have any more details on it other than that, but you get a sense here that there are still inventory issues they need to work through.
We believe that Qualcomm in the second half of last year had obviously gone through a significant inventory destocking cycle. We think that they, ended the year at kind of healthy levels. I think their customers did build a little bit of inventory because it was kind of a strong holiday selling season. And potentially maybe what they're cautioning here is just that as sell-through starts to slow, they're starting to see those inventories start to pile up again. In terms of balance sheet inventories, we are seeing days of inventory on their balance sheets come down about 19 days on a sequential basis, down 3%. But that's something that we're certainly looking for more color commentary on the earnings call for.
All right. Well, we'll let you get right to it. That call is starting shortly. John Ben over at KeyBank Capital Markets. A closer look at Qualcomm. A beat on several metrics there, including the guidance. The shares up by about 3%. And a lot of talk right now about chips and AI. Optimism for AMD. Actually pushing, helping to make NVIDIA-style processors and helping investors look past a rather downbeat sales outlook for AMD. CEO Lisa Su had a chance to sit down with our very own Ed Ludlow, and she said she's confident about what the technology can do in the accelerators market.
When I look at the potential of AI, it is really the single most important technology innovation over the last 50 years. So AI has so much potential to change the way our businesses work, to change our personal productivity, to really change the way we do research and a whole bunch of things. From our standpoint, we see the AI TAM growing to upwards of 400 billion by 2027. I think from an AMD standpoint, you were at our launch, Ed, in December. It was a great coming out party for the AMD AI capabilities, and it's gone really well. I think our customer interactions, our product qualifications, our ramp have gone really well. So we were able to update some of our numbers this past week.
I think a lot of folks focused on that ramp and how it went in the quarter. You exceeded the 400 million that you told me about at that event. So it's $3.5 billion of sales this year for MI300. What's interesting here is kind of your ramp relative to what's happening on the supply side. And I wondered how big a factor supply will be in matching or beating that number in 24.
Yeah, absolutely, Ed. This is the fastest product ramp, in our history. So, we exceeded our numbers in Q4, over 400 million. We're going to grow into Q1, and we updated our full year forecast from 2 billion to 3.5 billion. The way we think about that is that's a customer demand statement. So that is customers that we've engaged in, who have made commitments to us, who have placed orders with us. We're planning for a much larger number as it relates to the supply chain. This is what we should do. We always plan for success. So, my view is it's still very, very early in the innings for AI accelerators, and particularly for MI300. But this is an opportunity for us to continue to build a major growth driver as we work with our top customers on their AI plans.
And that was Lisa Su, CEO of AMD, speaking with our Ed Ludlow. And Romain, we have earnings. We heard from Qualcomm. We also heard from Qorvo.
Yeah, another chip maker here. Those shares up about 6% here in after hours trading, the beat here on their fourth quarter revenue numbers. Also the announcement of an acquisition here for a supplier of silicon integrated circuits here that's specifically designed for that push into what else? AI.
Of course, the buzzword of the year. Yeah. All right, coming up next, we're going to focus on the Fed and the short end of the curve with Ken Shinoda, portfolio manager at DoubleLine Capital. This is The Close on Bloomberg.
Welcome back. Let's look back to that Fed decision and the press conference by Jay Powell and a focus on the short end of the Treasury curve. Two-year Treasuries pairing some of the gains after the central bank held its benchmark rate steady as expected. But Chairman Jay Powell said it's unlikely that the Fed will cut in March, though he did leave the door open to a rate cut of some type at some point this year. Ken Shinoda joining us right now, portfolio manager over at DoubleLine Capital. And that's really going to be the parlor game, I guess, for the next few months. I mean, yeah, some point this year. That could mean the March meeting, that's off the table. It could be the May meeting. It could mean December. Do you have any confidence right now, A, that the Fed will follow through on at least one rate cut this year? And if so, why?
I think probably cut 3 times. That's what they've been telling us they want to do. I think the SEP plots are what their intentions are if the data allows them to. And going into this meeting, we definitely didn't think they were going to do anything today, and we were highly unlikely that March was going to be on the table. And Powell himself said that's unlikely. So it's wait and watch the data, see how that comes through. But higher for longer should continue to slow growth, should continue to help inflation stay low. And on a 3 to 6 month basis, core PCE is now sub 3% on the way towards their goals.
I am curious about sort of the market, the environment for trading around this. We know that uncertainty has created a lot of volatility. And one of our reporters at Bloomberg had a chance to catch up with one of your colleagues at DoubleLine, Greg Whiteley. And I thought he had the great quote. He was talking about how this decision kind of puts a floor under that volatility, meaning it will continue, and basically saying rates, spreads, liquidity, I'm quoting him, will all be choppy.
I think we lived in a decade of the best liquidity we'll probably see when we were in peak quantitative easing and the Fed was buying treasuries and mortgage-backed securities. And as we come out of that, we normalize into a world of, no QE, into a world of higher Fed funds, a more normal Fed funds rate. I think that we'll be in a more choppy, volatile environment. In 2024, will be that environment.
We have some pretty big swings in treasuries today. I'm looking at the short end, the 2-year yield down 12 basis points. And if you look at the movement since the 2 p.m. announcement, it's pretty much been all over the place. Tell us a little bit about what the positioning looked like heading into today's trade and how the headlines that we got out of New York Community Bancorp may have exacerbated things.
Yeah, I don't like to read too much into price action on Fed Day. I think the market needs some time to digest things. I think there was a lot of players perhaps just short the front end in case there was something unexpected that happened. And then once you saw that news this morning on the New York Community Bank, I think that led to a short covering that created that vol on the front end. So I think we want to wait and see how things shake out. I think it's likely that the front end probably heads back a little bit higher given Powell's stance on staying higher for longer.
Yeah, absolutely. Powell also made really clear that he doesn't see a need for the Fed to cut rates, because of real rates rising. So I'm wondering what kind of scenario would require the Fed to move sooner, perhaps in March or certainly before June?
Well, they need some type of negative event. They need an economic shock that would cause them to want to cut rates more aggressively. Right now, it's hard to predict what that is, but I think we're going to be a little bit of smooth sailing here in the near term. But things have gotten a little bit overbought. Stocks are at all-time highs. Optimism for risk assets is very high. Even the credit markets have run pretty dramatically. Investment-grade corporate bonds, high yield, have all gone really tight and spread. They're kind of like 10th to 12th percentile on a 10-year look back, and so we're a little cautious here. Some of those assets we talked about on the last Fed meeting in mid-December that had lagged the market, like non-agency mortgages and commercial mortgage-backed securities, CLOs, those non-traditional parts of the market, have been playing catch-up. And so that's played out, and now not much looks too cheap out there.
So in that environment then, I mean, not too much cheap here, but there, of course, we talk to a lot of folks. They talk about some of the tactical opportunities, particularly given the volatility, but also the idea that even longer term, if you are betting on a drop in rates and more importantly, economic conditions that will at a minimum at least be stable here, is there a case though for entry points right now, whether it's in high quality fixed income or longer duration or something like that?
Absolutely. I mean, from a long-term standpoint, the Treasury curve is at levels we haven't seen in over a decade. I know over the last couple of years, we've seen this positive correlation with stocks and bonds, which typically exists when CPI lives above 3%. But with CPI coming down 3%, I do think that negative correlation of stocks and bonds kicks into the safety of bonds and the risk off. So I do think that high-quality fixed income, especially Treasuries, look really interesting today. You don't have to go all the way out the curve. The belly of the curve should benefit the most as the Fed cuts, kind of that 2 to 5 year portion. And so I think investors should start, and we talked about this last time, you got to start coming out of those T-bills. I know they're still attractive.
No,
you
Ken.
got to start coming out of those T-bills.
No, Ken. There's some of us who are just scared of everything, Ken.
Ken Shinoda, portfolio manager at Double Line Capital. Yeah, well, urging everyone to maybe, put your toe in the market and come out of T-bills. Maybe look at taking on a little bit of risk. All right, and of course, what he said I thought was really interesting in terms of the 5 to 7 year, the belly of the curve will be the attractive entry point. But there's not a whole lot right now in the credit markets that is priced for opportunity.
Yeah, not priced for opportunity, but it's there, and we have so many people that say it's there. I mean, I was speaking with Earl Davis over at BMO, and he was actually chuckling at just basically how great, at least from a trading environment, it is. Maybe not from an investing environment. Yeah. But for a trader, this is where you want to be.
Ride the waves, right? All right. Coming up, we're going to speak with John Taylor of Stanford University. This is The Close on Bloomberg.
A focus today on the Fed and central banks around the world. Central banks that have actually been using the Taylor rule as one of their guides in deciding where to set the policy rate. Earlier this week, right here on Bloomberg, Apollo Global Management Chief Economist Torsten Slok gave us his view on what the Taylor rule suggests about Fed policy today.
The Taylor rule is just a fancy way of saying that what the Fed focuses on is its dual mandate. It focuses on where are we relative to full employment, where are we relative to inflation at 2%. And if you take the traditional way of looking at this, you will find that the Fed funds rate today, it actually, according to those frameworks, should be lower, namely around 4.5, relative to the 5.5 where we are.
And speaking of the Taylor rule, let's go right to the source. John Taylor joining us right now, senior fellow at the Hoover Institution and economics professor at Stanford University. And John, I'll quibble with one thing he said. He called this fancy, but I think the beauty of the Taylor rule is its simplicity here. And at least based on that calculation, rates should be coming down. Is that the right interpretation?
A little bit, but let's face it. They were up. They were as appropriate. They moved them up, and now they should be thinking about cutting it down. But I kind of like what the chairman said today, which we have a move towards that direction, but we're not moving exactly right now because they're a little worried about inflation picking up again. So I think it's about right. You can quibble a little bit about it, but I think they've moved the right direction.
I thought his comment was interesting too, meaning Jay Powell's comments. I mean, he really talked about this, how, this doesn't necessarily mean we're going to mechanically adjust policy. And he really talked about this idea here that they still don't really know where that neutral rate is or should be.
Yes, that's true. That's one of the big questions. I like how the reporters and the chair both refer to the Taylor rule explicitly. So that means they're thinking about this way about doing the job, which is good, which means they don't come down really too fast, but they come down at the right pace. And I think that's what I think about the rest of the year. Let's hope inflation moves in that direction so they're able to do this.
Yeah, he described it as saying we're really in a risk management role mode, avoiding moving too quickly, too soon. How would you grade the Fed's effort on that?
I think that I was complaining about the Fed when they were at 0.5% and the inflation rate was coming up towards 9%. But they got to, as we know, 5.25 to 5.5, and that seems about right. You can quibble a little bit, but it's about right. So I think that they're right now to stay close to this area to see if inflation comes down. And it's important Powell mentioned at least 2 or 3 times the 2% inflation target. So there didn't seem to be too much debate about that. And so they want to be sure they get it down, doesn't reverse, which would really cause a lot of trouble for the markets. I think just coming down gradually is the best way to make this happen.
Yeah, he said a lot about greater confidence as well. And when asked to really explain what that means, we want to see more good data, not better data, just a continuation of the good data that we've already been seeing. Does 3 more months of that qualify? What does that look like in your mind?
Well, even 3 months is a little bit short, quite frankly. Things can move back up. I think your chart there shows very much how the inflation rate came down. It's still coming down, but it's not permanent. It's not 2%. I think it's important they mentioned 2% several times today. And they kept mentioning it. It didn't look away. But I think the notion that he's also emphasized, and the Fed has emphasized, that a longer may be appropriate. So don't be surprised if they hold off a little bit longer than the 3 times during this year.
I think I ask you this question every time we bring you on for a Fed Day, John, and that's really your assessment of the communication that Powell has had, not only today, but really throughout this entire cycle that we've been in.
Well, I had problems with 1.5 years or 2 years ago where the funds rate was only 0.5% and the inflation rate was way high. So by the Taylor rule, other measures, they were way off. And that they took pretty aggressive action, I think, by comparative terms, and they brought it up to, as we know, 5.25 to 5.5, and I think that's much more appropriate. So while it was delayed, and people like me complained about it being delayed, but it got there, and I think now they're wise not to move it down too quickly and to follow the so-called Taylor rule and keep it where it is.
Do you think the economic conditions, the economic data, as they roll in, the economic data that Powell kept talking about, that they need to see more of, is that going to be cooperative?
I think so. It's my best guess. We were kind of worried that the low rates and this move to a high rate would shock the economy, but that doesn't seem to have happened. We have good employment numbers, we have good growth numbers. Growth came in at 3.1%, 3.3% for the year. And so I think that's a good sign. And I'd like to see higher growth. I'd like to see a little better fiscal policy, but not just monetary policy, but it's the whole ramp of policies that we're looking at the same time.
Yeah, that's a whole nother can of worms, isn't it? John Taylor, thank you so much. Senior fellow at the Hoover Institution and economics professor at Stanford University on this Fed Day. And of course, we talked about inflation. The Fed does have a dual mandate, not only to get inflation to 2%, but also maximum employment. And one key piece of data that helps the Fed make its decisions on monetary policy is the upcoming monthly jobs report. Those come out on Friday, and that'll give us some more insight into the strength of the labor market, which has been, as we've been reporting, very strong thus far. Let's turn now to Seth Carpenter. He is Chief Global Economist at Morgan Stanley. Seth, always good to speak with you. We heard from Chair Powell that we're not declaring victory. We have a ways to go when it comes to the economy and a soft landing. He didn't even want to say soft landing in that way. But he did say that when it comes to the labor market, we're normalizing and things are looking better. How will Friday's jobs report advance that picture of a normalizing labor market?
It's a great question. I mean, I think we can start even earlier. We just got data on the employment compensation index, and it slowed again. So again, showing more of that balance between supply and demand that Powell was talking about. You had up on the screen just before sort of the consensus views. We're actually a little bit higher than that. We're looking at just over 200 for headline, a bit below for private payrolls. So that's not showing substantial slowing. We do think the economy is slowing down. We do think the labor market and hiring will slow down in coming months and quarters, but we are not looking for anything where the labor market just rolls over and falls off of a cliff. And if anything, if we're right and we get just slightly north of 200,000 in payrolls, then I think the market reaction when Chair Powell said March is not the base case, I think the market will take that even more to heart. Our base case, in fact, is all the way back in June, and we're feeling pretty comfortable there.
So you're seeing a rate cut when it happens in June. What does that mean in terms of May and the adjustments to the forecast that the Federal Reserve does make when it does release its next statement of economic projections?
Absolutely. So they're going to have to confront lots of different things. The last time they made the statement, their projections was in December, and we've got a lot of information since then. The economy in 2023, which is now history, but we got new data on that, was stronger than they had realized. The unemployment rate, at least so far, has ticked up a little bit. We'll see how that goes. I think the main thing, though, is that they're going to have to ask themselves, what are they going to do with the policy rate? Inflation's coming down. It's consistently surprised them to the downside for the past 6 or 9 months. And so I suspect they'll build in a little bit more in the way of rate cuts for 2024, but nothing like the 6, 7 rate cuts that we've seen the market pricing in at times.
I thought it was interesting because Powell was asked this repeatedly, and he dodged the question repeatedly. But it gets to this point here, too. He talked about this idea that there is a lot of disagreement right now in the Fed, and then he made a joke about, you can see it in the transcripts, which I think come out in 2050 or something. But it gets to this idea that when you have that type of disparity in views, and I know he's the one kind of driving the show here, but how much is that going to end up factoring into, I guess, how the market sort of tries to predict what the Fed does next? Is this just going to be about what Jay Powell says and what he wants, or are we going to start to see a much greater accounting in the market of what we hear from the other Fed members, the voting members?
All of the above, I have to say, Romaine. I mean, if you look at the market pricing for a March cut over the past, go back to the beginning of November, we've seen it go from no cut price to well over a full cut price, back to where we are now with about a third of a cut price. I think all of that is a reflection of lots of things happening at once. We're at an inflection point. The economy was strong in 2023, but inflation came down a lot, and we think we're going to see some more slowing. It's always hard to call any sort of inflection point, and there'll be different views around the committee, and you see that in committee communication. There was tepid pushback from some FOMC participants against being too premature on a rate cut. There was your namesake, Raphael Bostic, who was saying they're probably not going to cut until Q3 of this year. And so I think that range of views is there. The market gets to pick and choose. But at the end of the day, as you said, Powell is driving this bus. I think he has shown that he wants to be very cautious, very deliberate. Between now and March, we get 2 more CPIs, we get 2 more non-farm payrolls. That's a lot of information about the trajectory of the economy.
So this gets us back to the inflation question. And by the way, Raphael, my favorite Fed member for obvious reasons. But this gets us back to that inflation question, Seth, and this idea of kind of what economists really look at. I mean, I feel like historically it really was all about sort of that demand cycle here. And now we're he spent, I don't know how much time talking about supply chains. And of course, we're headed into an election year that a lot of people think could have a major impact on at least where fiscal policy goes. And that, of course, would then feed into monetary policy.
No question, and I think the reference to supply chains was important. And if anything, this ties back when you just had John Taylor on. One of the things that's tricky in applying those sorts of mechanical rules is part of the surge in inflation was not good old-fashioned sort of cyclical macroeconomic inflation, there were supply chain disruptions that caused goods prices to shoot up. Now we're seeing the reverse of that, with goods prices starting to come down, at least on average over the past 6 or 9 months. And I think that makes all of this inference harder. Chair Powell and the FOMC statement said they're looking for inflation to move towards 2%, quote, sustainably, not just to touch 2%, but to be there, over time, including a year from now. Well, that goods deflation from the healing of supply chains, I'm not sure you can count on that being around a year from now. I think Chair Powell alluded to that same thing, and it makes their judgment super tricky. So I do think the slowing in the economy from policy is going to help with the services side of the economy. I think the good side of the economy, disinflation or even deflation, that's taking care of itself. And it's a real judgment call for the committee. As long as the real side holds up, though, they have plenty of flexibility to wait and be sure.
All right, Seth Carpenter, Morgan Stanley Chief Global Economist, thank you so much for joining us on this Fed Day and helping us look ahead to some of the data that the Fed will need to consider and that investors will need to take stock of as well. We should mention, of course, that today was a down day for equities. Stocks actually saw their biggest decline on a Fed day since March of last year. And of course, a lot of that, Romain, was because of what we had heard from the big tech companies that did report yesterday.
Yeah, and I'm glad you bring that up here because right now in after hours trading, we were talking about Qualcomm and those earnings results. Those shares had rallied in after hours trading, now flipping to losses here, down about 2% here right now. And it gets to the question here as to whether all that, the potential good news, AI and everything associated with it, that's already been priced into the market.
Yeah, well, investors got ahead of themselves, certainly when it comes to AI and when it comes to actually putting numbers to the actual optimism, perhaps that didn't measure up.
And that brings us to tomorrow, right? We get Meta, Apple,
Amazon,
and a lot of other second-tier tech companies. So that's kind of the last hope, right?
Yeah.
I mean, if we're going to see big growth stories there, we got to hear it from them, or maybe we're not getting it.
Yeah, 3 of the Magnificent 7 will be reporting. So all stuff to keep an eye on, and all stuff that we will be covering for you. This is The Close on Bloomberg. The U.S. banking system is sound and resilient. The FOMC said that in December, but that line is noticeably absent in today's statement, which is raising eyebrows, especially given the plunge in New York Community Bank shares. The lender tumbled by the most ever after reporting a surprise quarterly loss because of increased provisions for bad loans tied to commercial real estate. Is this a return of banking instability following last year's regional banking crisis? Let's turn now to former Fed Governor Betsy Duke for her take. She has also served as chairman of Wells Fargo and chairman of the American Banking Association. Betsy, thank you so much for joining us today.
It's a pleasure.
So how are you reading the reaction, perhaps outsized reaction to New York Community Bank's results, which certainly surprised everyone because the provision for bad loans was about 10 times what analysts had anticipated, but it is some kind of quantifying of the commercial real estate concerns that have been really lingering in the market for over a year now?
So first of all, as a community banker, I want to say that New York Community Bank at over $100 billion in assets is no longer a community bank. And so this is not something, when you hear community bank, I wouldn't want anybody to think this is an issue with community banks generally. This is a bank that's very large and has just gone over the $100 billion asset level that is giving it a lot closer regulatory scrutiny, and the regulatory scrutiny on banks that size is a lot stronger than it was before the issues that we had earlier this year. So looking at what they have particular, this appears to be not a capital issue per se, but really an issue of loan quality. As you've had downturns in the past and as you've had particularly credit deterioration, there are going to be numerous announcements of this is a very large provision that we're taking, always sort of in the context of we're trying to get everything out of the way at once, and this is all of it.
So how do investors? I'm sorry, go on.
There's never just one cockroach. So usually when someone says this is all of it, it may not be all of it, but an issue in credit is a bit slower moving than something which is a liquidity issue.
Thank you. That's a really important point. So how do investors discern between something like this, where New York Community Bank Corp is saying, which again, not a community bank, as you mentioned, saying we're going to be cautious, we're going to write things down, we're going to, account for possibilities that things are going to go bad, versus the kind of quick moving mark-to-market issues that we had seen in the past that prompted a run on banks?
So one thing, it's a little bit hard to tell because this will be the first credit cycle since FASB changed the accounting for loan loss reserves. So the current accounting is supposed to take account of through the cycle losses, and so it's going to be interesting to see how that actually plays out in this cycle.
So get us to a sense here, Betsy, when we talk about the health and the stability, really of the banking sector overall. I mean, we're not just talking about community banks, but even the ones that are a couple of legs up, all the way up to the big money center banks here. Is there anything, at least from a monetary policy perspective, that the Fed needs to be worried about?
Nothing from a monetary policy perspective. And even from a general health of the system perspective, I don't think so. I think you will see individual institutions that are heavily that their balance sheets are heavily weighted in commercial real estate may have more issues than others, but I don't see this being something that's contagious.
I ask that because we know there are still a lot of proposals out there right now when it comes to the regulation of banks and capital rules, whether you talk about the Basel Endgame proposals that have to be finalized or some of the other potential rules that could come out of the Fed and the other agencies here. Are we going to be looking at an environment, I don't know, in a couple years' time, where the capital requirements, at least on the bigger banks, and to that extent maybe in the mid-sized banks, is materially higher than where they are right now?
I don't know. I don't know where the current capital proposal is going to end up. And the real thrust of that proposal is a capital charge for operational risk. Mm-hmm. And I don't think the regulators have ever defined what they mean by operational risk. And so right now they're using revenues as a proxy for that risk. And I'm just not so sure that makes sense. And I think that's what's got the banks very much concerned. It does not look like this is going to be an easy road to approval, and it's hard to tell what. I'm certain that there are going to be a lot of changes to the proposal. I think there's a good chance that there will be a reproposal of a rule that's calibrated somewhat differently.
Well, this gets to the idea, too. I mean, Michelle Bowman, of course, a Fed governor, has really pushed back on the prior proposal. It's not quite clear exactly what she wants, but certainly what she wants is something that, in her view, is a little bit less onerous than what was originally put on the table.
I think that's right. And I think a number of the governors have expressed some concern, even in the meeting. She was the most vocal, but I think there are several who have some concerns. And, one of the purposes of an open meeting like that is to get those questions and concerns on the table. This proposal will include a number of questions that they want comment on. Yeah. And so, they're waiting for those comments. It'll take a while to compile and digest all the comments and for all of the agencies to have a discussion and come to a conclusion as to where they go next.
Just to kind of circle back to where we started, do you think when we get the minutes of this Fed decision and the Fed meeting that we're going to hear them discuss New York Community Bank or the regional banks or the big banks in any way in terms of how they're thinking through monetary policy?
I'd be very surprised if that's part of that discussion, or at least at the level that it makes the minutes.
All right, Betsy. Always great to talk to you, and always appreciate you taking time for us. Betsy Duke there, former Fed governor, former chairman over at Wells Fargo. A closer look here at the Fed decision and maybe some of the potential banking regulations coming down the pike. Stick with us. We're going to set you up for what to watch. This is Bloomberg. All right, there was no doubt about what the big market catalysts were going to be today, but let's push ahead over the next 24 hours and set you up for what to watch. And we start with another central bank decision.
Yeah, this time from the Bank of England. So New York time, that'll be about 7 a.m. when the decision comes out. No change expected, but according to Bloomberg Economics, there will be at least one of the 9 members that will vote for a rate cut. And usually what that means is that 2 meetings later, the rest of the committee tends to follow. So take that as you will.
It'll be interesting to see what happens there. EU leaders also set to meet tomorrow in Brussels. This is a special summit, I'm told, surrounding some of the issues going on right now with the military war, with the war in Ukraine and the military assistance.
Absolutely, and this is something we'll be watching for. A lot of the EU leaders are also kind of thinking through what the world will look like in November if former President Trump is elected, and what that means for their military spending as well.
Absolutely, not just an academic exercise. It has a feed through into the economy, and we do get more economic data tomorrow in the U.S.
Jobless claims at 8:30 a.m., high-frequency data point. Of course, it's part of the lead-up to the jobs report on Friday, but that's Friday.
All right, let's get right to it. The big events tomorrow is going to come after the bell. Scarlett and I will be here, full market coverage of some big earnings.
Apple, Amazon, Meta. We already heard from Alphabet that the ad spending market was not great last quarter, so that has huge implications for a company like Meta. Also for Amazon, which increasingly is relying on advertising.
Yeah, basically rounding out the Magnificent Seven, sans NVIDIA. We have to wait a couple more weeks to get them. Tesla, of course, has been the big laggard, and the other companies just kind of a mixed bag.
Yeah, Alphabet was not a good one for the Mag 7.
All right, we'll see what happens tomorrow, and please tune in. We'll have full coverage of those earnings, better than anywhere else. In the meantime, stick around. All your politics coverage coming up on Balance of Power. Scarlett and I will be back tomorrow. Have a great evening. This is Bloomberg.